All right, so I did the trade again today, Friday, March 27th. I sold a put spread on the SPY expiring the same day. So the SPY opened Friday, March 27th. It opened 253.27. So remember my probabilities that I was talking about. So if I look at open and close, but all periods, the SPY has a 99.68% chance of closing higher than 3% lower of the open price, or in other words, it has a 99.68% chance of not closing lower than 3% of its open price. So the open price on the SPY, I said, was 253.27. That's what it opened at, not the previous close. As you can see, the previous close was 261.2, but it opened at 253.27, and that's why this strategy seems to work, is because most of the movement happens after hours, not intraday, but after hours. All right, so what's 3% lower than 253.42? So it's going to be 97% of 253.42. So it's about 245. Okay, so I ended up selling a put. Actually, let's go back to the probabilities. So this covers all the periods, but right now we're crashing, so it's a different kind of period. So if I compare 2007 and 2009, which is the last crash, which is the last drop, it was a straight line down. Let's see what this probabilities give me. If I go at 3% as well, instead of getting 99.68%, I'm getting 96.83%. So it's a bit lower, but it's very justifiable because we were in a crash. But it's still a very good probability that the SPY will not close lower than, it's got a 96% chance, or almost 97% chance, that it will not close lower than 3% of its open price. So that's pretty good. It's a pretty good winning probability. So that 3% lower mark is 245. If I go back to my Questrade account, you can see my two transactions over here. So I sold a put spread expiring the same day, March 27, 245, 240. So the short strike was 245. The long strike was 240. I collected 65 cents or $65 for this trade. So my max loss is the difference between the strikes, $5 minus the 65 cents, so $4.35. But of course, max loss is achieved if SPY closes at 240 at the end of the day. And that probability is, what's the probability of the SPY closing at 240? Well, let's look first at how much lower is that. So 240 divided by 253.27. That's 94% minus 1. So it's 5.2% lower than the open price. And if we go back to our probability chart, and if we look at the 2007-2009 period, 5.7%, I said, 5.2% is around here. So there is a 98% chance that it does not close lower than 5% of the open price. So even for me to achieve max loss, I've got an even higher probability of that not happening. But anyways, in any case, I don't plan on going into a max loss. My mitigation strategy or my exit strategy is, if this 65 cents becomes 3 times its value, when would that happen? That would probably happen if the SPY drops to around 245 or 243. And it also depends when it reaches that. If it reaches it in the morning, if it reaches 245 in the morning, then the value of this credit that I received might be valued at probably 2 times or maybe 3 times. But for sure, if it drops below 245, then it starts to increase, and I might start thinking of closing the trade for a loss. So my max risk really isn't going to be the $4.35, because I'm not going to let the trade go that far. I would get out of the trade maybe at 3 times the value of 65 cents or 3 times the value of the credit received. So my max loss would be basically double this value here. So about $130 would be my max loss. I haven't exactly decided what would be my exit strategy, because I could also just keep it and just sell call spreads as the SPY is dropping. I could sell call spreads to collect more credit and actually reduce max loss. And what that does is it gives me a chance. It gives a chance for the trade to win. Maybe by the end of the day, even if during the day the SPY dropped to below 245, maybe it comes back up above 245 and the trade becomes a winner. So there's 2 ways of really mitigating or managing the risk on this trade. Either you pick an amount that you get out at and just take the loss, or you hold the trade till the end, but you keep selling call spreads as the trade goes against you, because it acts as a hedge. the SPY is not going to drop below 245 and be above 250, for example, at the same time. It's either going to be below 245 or it's going to be above your call side. So by selling a call spread as this trade goes against you, as it drops below 245, you're collecting credit and you're giving a chance for the trade to win. So either this way or this way is my opinion, but I'm not sure yet which way I would take. But regardless, for sure, I'm not gonna let the trade go to max loss, which is $4.35. That's not happening. And the other thing I looked at is, compared to the open price, how low can the SPY drop from the open price intraday? So if I compare the open price to the lowest price, if I look at all the prices of the SPY since inception, and if I look at a 3% drop intraday, you could see that 99% of the time the SPY intraday will drop as low as 3%. The SPY intraday will drop 3% lower than the open price intraday, but it might not close at this price. It might drop. This will be the lowest point, and then it'll come back up. Because if we compare the same thing with the close at 3%, you could see that it's 99.68% chance of not closing below 3%. So if we look at number of occurrences, I'm covering 6,837 occurrences. So you could see that here it says basically that out of 6,837 occurrences, only 22 occurrences did the SPY close lower than 3% of its open price. That's pretty good. And basically in percentage terms, it's 0.32% of the time that the SPY close below 3% of its open price. That's amazing. Now let's look at, so now I've got the same number of occurrences, 6,837 occurrences. Now let's see how many times has it gone lower than 3% intraday. So it reached as lower than, it went past 3% during the day, but did not necessarily close at 3%. So you could see that we've got 59 occurrences where it has gone below 3%. So that's what I need to worry about, because if I manage my trade at 3 times the credit received, I want to see how many times this part here happens, because that's when that's when my put spread is going to be in trouble. It might not be a loser, but it'll be in trouble, because it's only a loser if it closes in that range. But the fact that it reaches that range during the day, it puts my put spread in trouble, and I have to take action. And to see how many times that event happened, it happened 59 times out of 6,837 occurrences, and in percentage, that is 0.86% of the time that happened. So even in probabilities, it's still amazing. But now I'm comparing all the periods since inception. Let's look at 2007, 2009. So like we said here before, the SPY has a 3% chance of dropping below the open price by 3%. That's between 2007 and 2009. That's pretty good. It has a 3% chance of actually closing the day 3% lower than the open price. Okay. Now, if we compare the low, 2007, 2009 open low, if I look at occurrences, I've got a total occurrences of 630. That's between 2007 and 2009. So I'm basically looking at 630 business days. And out of those 630 business days, 30 times only during 2007 and 2009 did the SPY drop lower than 3% of the open price intraday. And in percentage, that represents 4.76%. So that's still a very good percentage. So only 4.76% of the time during a market crash, or during the last market crash, that would I have been tested on my put spread, which is 3% lower than the open price. That's basically what this means. So of course, I acknowledge that not all market crashes are the same. Just because the market crashed, just because these are the probabilities between 2007 and 2009, does not mean that it'll be the same probability in a 2020 crash. That's absolutely true. But it's the most likely scenario that it's going to be something very similar. If it's not going to be 4%, it's going to be 6-7%, but it's going to be in that range. It's not going to be 20% of the time. We're not going to have a completely different probability. So it's like flipping a coin. If you flip a coin 10 times, if you just flip a coin, what's the probability of getting heads or getting tails? So normally you would say it's 50-50, but if you flip it 10 times, you might actually get 7 heads and 3 tails, or 8 heads and 2 tails, because it's a small amount of occurrences. But if you flip a coin 1,000 times, you get closer to the true probability, which is 50-50. So it's the same thing. So I'm covering over 6,000 occurrences, and that these are the probabilities that I'm getting. So these probabilities here are closer to the truth. So it is very possible that if I do this 3 times, that I fall on the worst 3 times ever. But the more I do it, the more I get closer to the true probabilities. All right, so going back to the trade, I feel like I've been talking about probabilities for a while. So yeah, so I sold the put credit spread at 65, at a 245 short put, collected $65. And then if we look at the SPY, let's see what happened intraday. So it traded around 254, dropped a little bit, 252, 251, I think even almost 250, and then back up again. It was a bit choppy in the morning. I had a chance to close it for 50%. I didn't close it for 50% because I only have one contract, so it's only $65. If I close it for 50%, I pay $32 plus commissions. It's going to eat up my profit. So I kept it. My intention was to let it expire worthless so I can keep the full $65. But of course, I didn't want to make that same mistake again with the mistake that I made on Wednesday by not closing at 50%. So when it was trading, when the whole put spread was trading for 13 cents, I ended up closing the trade for 13 cents. So basically my profit on this trade is 65 minus 13. So dollar wise, it's not a big amount, but what's great about this is the strategy, the fact that it was a simple high probability trade with a very good chance of winning, and percentage wise it's a good percentage, a good return on capital. Because what is the return? What is the risk? The risk is basically what I intend on losing on the trade. That's my risk. So what I intend on losing on the trade was 2 times the initial credit received, so about $130. That's my max risk, and the profit was about what, $40. So 40 divided by that, by $130 risk, that's my return on capital. So it's pretty high for a 1-day trade. And this is one contract. Nothing stops me from doing 2 contracts or 5 contracts or 10 contracts. So instead of making a $40 profit, it could have been easily a $400 profit. It would be the exact same buttons that I would have to click to place this trade. Instead of being 1 contract, it's 10 contracts. So it's very scalable. So that's what I like about this trade. And this is really, for me, it's proof of concept that this trade worked, because I did it on Monday. I paper traded on Tuesday, did it on Wednesday, paper traded on Thursday, and Friday did it again, and all the put spreads were winners. So 5 days out of 5 days that I started this, the put spreads ended up winning. So the probabilities might be true. Now the SPY ended up closing at 253, so I actually could have let it expire worthless and would have kept the full 65. But of course, why take the risk? Well, I don't know that. And if I'm actually doing 10 contracts, I'm going to be risking a bigger amount. So it's not worth taking the risk if you're trading with a bigger amount. So I wanted to develop something that's more sustainable, a sustainable strategy. I wanted to implement or practice the right behavior, even if it's right now I'm just using 1 contract, but it's just to get discipline, because eventually I want to increase the number of contracts. So trying to find a system that I can put in place. And even it reached 260, so I could have closed it for even less than $13. Could have probably closed it for $5. But regardless, I'm still happy with the trade. Not necessarily the dollar amount, but more the proof of concept. Okay. And I repeat once again, the reason this seems to work is because what I realized is most of the movement happens after hours, outside of market hours. So even if we're crashing, the 10% drop happens before the market opens. Once the market opens, I'm comparing the closing price to the open price. So I'm not exposed to overnight risk. And based on past history, comparing the closing price to open price, 3% away from the open price is generally safe based on all these occurrences and probabilities. All right. So yeah, just wanted to share that with you, this trade. Let me know what you think in the comments below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.